In this session, I'm going to look at the different mechanics that are associated with the futures markets. As we all understand, futures as well as forwards, both of them are primarily agreements to buy or sell some asset in future at a price that is decided upon today, on the day of entry of the contract. The only difference being the futures are generally the contracts which are executed on an exchange, whereas forwards are those contracts which are executed between the two parties over the counter. So, when the exchange is involved, I would like to know what are the various specifications, what are the key things the exchange would come forward with as we are looking at the futures contract. What are the various elements that should be present as a part of the futures contract? Then I would also look at how the futures contracts eliminate the credit risk by bringing in the concept of margins. What do we mean by a margin account? How does the margin process really work? And typically, what are the various regulations that are associated with respect to this futures market? How are the quotations generally done in the futures market? And anything to do with the accounting and tax kind of perspectives? How are the futures transactions accounted for? What are the taxable kind of processes that are associated with the futures contract? I would be dealing with all those things, the operational part of the futures market as a part of this session. Right, so definition wise, you're all clear what a futures contract is, so I'm not reiterating the definition part of it. But yes, in again, because this is a exchange related transaction, it could even go with an open outcry kind of a process where a buyer and seller are shouting out the price and they are actually deciding upon the price on the floor of the exchange. Or nowadays, as we have discussed, it is moving more to an electronic trading mechanism where the buyers and sellers are meeting over the virtual networks, which are the computers, and computers are physically matching the buyer's deals with the seller's deals. And the long position is what the buyer's position is called as, and short position is what a seller's position is called as. And we have also understood that the price that is set is purely based on the demand and supply that is existing with that particular asset. So at any point in time, I see more sellers. The sellers are more than the number of buyers. Obviously, the price has to go down. Normal demand and supply fundamentals. The price has to go down, and this reduced price will motivate more buyers to actually enter into the market. So as the buyers are increasing, again the price will go back. So the equilibrium between is maintained, because as the demand is increasing, the price is going up, or if the demand is decreasing, the price is going down. This will pull more buyers into the market, which would result again in the price going back into its equilibrium state. That works just like any other buy sell transaction. So the futures transactions is not anywhere different from those. But one important concept that comes out as a part of understanding this futures market is closing before maturity. Majority of the futures contracts, they don't go until the maturity date. The trader, let's say he has entered into a long position on 1st Jan 2014 for a March delivery contract. Now, which means the real buying of the underlying asset, whatever it is, let's say that is a wheat futures. So the real buying of wheat will happen in March 2014, and the price of it has been decided on 1st Jan 2014. Now, what we are saying is, if this contract exists until March 2014, the long position has to pay whatever is the agreed upon price to the short position and take the delivery of the wheat. But in this case, what generally happens is the same participant will enter into a short position, let's say on 10th of Jan 2014, for the same March 14 contracts, March 14 wheat contract for the same quantity. Now what is happening? It looks as if on the same date, the buyer is buying at this price. On the same date, he has got into a contract to sell it at this price. So the buy price, the sell price, both of them are known even before the maturity period itself. Irrespective of what the market price is on that particular day, the profit is already locked, or the difference in the prices is already locked. It could be a profit or it could be a loss. So this kind of situation where a single trader gets into both a long as well as a short position for the same maturity, for the same asset, for the same quantity, then we are saying that the position is closed out, or it is called as offsetting kind of a position. So in this case, there is really no need for any kind of a delivery, because the long is buying wheat from some location and he is selling wheat to some other location. So obviously there is he really need not have a physical delivery of wheat at all, because both of them are offsetting each other or closing each other. So before the delivery date, if a trader enters into the opposite position for the same quantity, same delivery date, we call that those positions are offsetted, means there is really no need for any kind of delivery. No delivery exists in these kind of situations. That is what we call as either an offsetting position or our position is closed out. And whatever the gain or loss the investor is making, I know at this moment on 10th Jan itself, I know what is the gain or loss, because if it has come that the futures price here is 1010 and on this day the futures price is 1015, it means on March 2014, this guy is going to buy wheat at 1010 and he is going to sell wheat at 1015 in March 2014 itself, which means in March he is going to make a profit of 5, and obviously it's a known fact. It's nowhere uncertain, because you are able to lock up your profit or loss by getting into two different positions for a future delivery itself. So those are what typically happen in the futures market. You see that most of the positions, more than 98% of the positions are closed out before the delivery itself, which means the gain or loss on that for that particular trader is simply determined based on the futures prices for both the long position as well as the short position. So to a large extent we see that the trades get closed, but still it's better that we understand the delivery process also, though majority of the times we see that the delivery does not happen. But yeah, sometimes in some situations delivery does take place, so we need to understand what is the mechanism that is associated with the delivery. And generally when we are talking about when we are talking about pricing also, whenever we are deciding the futures price, we try to base it on the spot price as well. So the linkage that is existing between the futures price as well as the spot price is also something that we have to really understand, because anyhow it's the same underlying asset. If it creates completely different pricings in both the markets, again arbitragers may come into picture, buy in the cheaper one and try to sell in the expensive one. So even that dimension is what we are going to look at. Now coming to the key specification of a futures contract. Key elements present in a futures contract. Because exchange is a driver, the exchange is the key driver in case of futures contract. Exchange has to specify very clearly the content of the agreement, of the futures agreement, the wording, the content, and a few essential elements need to be taken care by the exchange. Especially, I would like to see what the asset is. When I say what the asset is, I want to know whether it is a commodity or is it a financial asset. Because if it is a commodity, there could be a possibility of quality, grade. So a clarity that should come in terms of the physical characteristics of that commodity. So if there are multiple grades, probably the prices could differ for each of the grade depending on the quality. So that is where we see that in case of commodity, the difference will come up. Whereas in case of financial assets like your stocks, bonds, there is a lot of unambiguity at all, because there is nothing to do with the quality of the asset. It's a stock, it's a bond, it's an index. So there's nothing to do with the physical quality associated with it. So the clarity in terms of asset needs to be provided by the exchange. Of course, we'll deal slightly later that there are a few assets, financial assets, where some kind of clarity in terms of what is the exact instrument, especially in case of treasury bonds, we'll be seeing what is that exact bond that can be delivered. But in case of commodity, for everything, the quality specification is one of the most important aspects. Then apart from that, the the size of the contract needs to be very clearly specified by the exchange. Size means basically talking about uh, what is the amount, value of the asset in one single contract. This can't be too high or too low, because the moment its value is too high, probably small players may not participate in the contract at all. Small hedgers, small speculators may not participate in this transaction at all. So which means the volumes will go down, the liquidity will be much lesser. So it can't set the contract size to be too high, and at the same time the contract size cannot be too low, because that will result in the costs growing up, because for every contract there is a transaction fee. So the transaction fee for more number of contracts is getting increased, which will increase the overall cost of the transaction. So probably yes, determining what is the size of the contract, how many units, probably if I'm talking about wheat, how many tons or how many quintals would be delivered as a part of one contract. Whenever a person is trading in, what should be that minimum size for which the contract for which he need to enter? What is that multiples for which the contract needs to be entered into. That's one more dimension which the exchange need to specify. 3, the location of the delivery, especially if there is a delivery involved. The location, is it only one or multiple locations? If there are multiple locations, then depending on the location that has been chosen, the price can vary. Price can change with location, because some locations which are quite away on interior, they are not accessible from the regular accessibility mechanisms, regular transportation mechanisms. Probably the price associated with them will be slightly higher as well. Then the fourth dimension that needs to be set by the exchange is the date. The date on which the maturity date of this particular contract. Generally, in case of futures, we talk about delivery month, not the date. So probably we'll say something called March 14 futures, or probably we'll say July 14 futures. So the month is quoted rather than the exact date. And for different kinds of futures, the delivery date is clearly set by the exchange at the beginning itself. In some kind of future contracts, the delivery date could be any time in the month. In some cases, some exchanges set them as, let's say, NSE sets the National Stock Exchange in India sets the delivery date for the contracts probably the last Thursday of every month, whereas NCDEX, which is the Commodities and Derivatives Exchange of India, it sets the delivery date as the 20th day of the month. So like this, what we see is different exchanges set different dates associated with the delivery part of it, or in some cases the delivery can be there during the entire month. But this, whatever is the delivery date or the delivery month or the specific dates of delivery, they all need to be specified as a part of the contract specification at the outset itself. And generally the trading in terms of the contracts happen for that particular, for the nearest delivery month as well as few of the farthest delivery months. And the exchange will clearly mention when will the trading start for each of the delivery months and when will they get ended. So that mechanism is mentioned as a part of the specification. Then we are talking about the codes, the price related codes. What is the currency that is used? Is it just the rupees or even the rupees and paisa are used? What is the major tick size? If at all there is an increase or decrease in the price, by what extent the increase or decrease could be there? All these things are specified in the exchange specification itself. And there are mention about the price limits. So the price limit is nothing but the maximum change in price in a day. Maximum change in price in a day. So probably if the price limit is set as $10, what does that mean? Today if the futures price is 200, during the trading process in the day, if the futures price goes to either 190 or 210, if it has gone to 190, it means it has gone to limit down. If it has gone to 210, it has gone to limit up. If it can go either to 190 or 210, we call it as a limit move. In any of these limit moves coming up either to 210 or 190, what we are saying is the exchange can stop the trading for the day and it can continue in the next day, or it has the flexibility to intervene and modify the limits if it really wants to. The main intention is preventing large movements in price. Because of one or few speculators who are operating in the market, they don't want the price to move exorbitantly high or low in one single trading day. Otherwise, speculators try to take advantages by trading in large quantities and making the price movements in a very drastic direction. But at the same time, if the price of the underlying security is moving drastically, this looks as if there is an artificial speed breaker that has been put. So it has to be, in that case, the exchange can intervene and do the controlling mechanism as per the requirement. Similarly, one more thing that can come out as a part of the specification is the position based limit. How much, what is the maximum can one single trader, what is the maximum number of contracts that he can get into, especially in a speculator position. If he is in a hedging position, no issues. Any number of contracts can be traded, but if it is from a speculator kind of a role, the maximum number of contracts that can typically be held by one single trader has to be specified as a part of the position limit, because that is what will prevent these speculators from putting up some kind of undue influence on the market. They should not influence the market single-handedly. So just to avoid that kind of a situation, the position limits are coming into picture. Just to understand from a reality standpoint, I have taken one of the contracts which has been specified on the NCDEX, the Exchange Commodities and Derivatives Exchange of India. This is the wheat-based contract, wheat-based futures contract. The unit of trading is 10 metric tons. Maximum order size is 500 metric tons. The price is quoted as the rupees per quintal, and the price increase is in rupees. So no paisas are involved in the process. And these are the specifications with respect to quality, because it is a commodity. So something to do with the quality of it, the damaged kernel, foreign matters present in the kernel. So this is something that has been designed, and quantity variation is plus or minus 5%. Then delivery location is specified as Delhi, but at the same time a few more additional locations have been specified. Right, the opening of the contracts first day of the month in which the near contract is due to expire. Then the closing, the clearing and settlement of the contract will commence within the commencement of the tender period, and T plus 2 corresponding buyer match. Okay, then it is specified that the expiry date is the 20th day of the delivery month, and if it is a holiday, Saturday or a Sunday, it is immediately preceding trading day of the exchange. Then we are talking about the delivery specifications, number of active contracts, the price band, daily price fluctuation is plus or minus 3%. If the trade hits the prescribed daily price limit, there will be a cooling off period. Cooling off period for 15 minutes. Trade will be allowed during this cooling period, and would be raised by another plus or minus 1%. Again, on the other side, it is lighting up the reverse price band of 4%. No trading will be allowed for the day. So some kind of limits are being set, price limits, then position limits, 100,000 metric tons or 15% of the market wide open position, whichever is higher, and some kind of specifications with respect to the margins and all. So this is what typically goes as a part of the specification that is given by the exchange for each futures contract. So we need to have a decent understanding of the various specifications associated with the futures contract, so that the trading can be taken care of quite comfortably, right? Now, the next important concept that is worth looking at is the convergence that is happening between the spot price and the futures price. See, we see that the futures price is a price which is agreed upon by both the parties for some transaction at a future date, right? So, at a future date. Now, if the future date is same as today, means there's nowhere a future anymore. So the futures transaction price should also be more or less same as the today's price itself. See, if the today's price is some $100 and I'm talking about the futures price is 105, okay, and the future is 5 days away from today. All right, it makes sense. Today the price is 100. The same asset I can purchase it at 105 after 5 days. So there is some kind of a logic because this is something to do with a future date. But as the future date and the current date are as the future date approaches the spot, means as the days of maturity, as the date for maturity is coming closer and closer, there is not much of a difference between the today, which is the spot, and the future date. So the meaning of the future is nowhere getting applicable there. And that's one of the prime reasons we say that whatever may be the situation earlier, when there was a huge gap between the spot and the future, but as long as they are coming closer and closer, I see that the future market price will have to approach the spot price. That's one important point to be noted. As the maturity period is approaching, we see that the futures price converges to the spot price. Because in any case, probably assume that the futures price is very much greater than the spot price or very much lower than the spot price. If it is greater, what the investor will do is he will sell a futures contract, buy the asset in the spot market, and immediately deliver that asset. So he is selling it at a higher price, buying it at a lower price, and making a profit within no period of time, within very quick period of time. And that kind of an arbitrage profit that is being made will create more and more sellings in the future market, more and more buyings in the spot market, resulting in the spot price going up, futures price coming down, the arbitrage opportunity getting eliminated. The same logic will go if the futures price is lesser than the spot price. There could be a long position in the futures market. There could be a short position in the spot market. Again, the same, buy at a lesser cost, sell at a higher cost, and probably make the arbitrage profit. And the demand for such kind of things will create increase the price in a cheaper one, decrease the price of an expensive market. So that's one of the prime reasons we see as the maturity date is approaching, the futures price will be converging with respect to the spot price itself. Now comes one of the most important aspects of the futures contracts, the concept of margins and the concept of daily settlement. which is otherwise called as mark to market. Now, we understand that in case of a forward market, there is a problem of one of the parties defaulting. One of the parties can default if the deal is not in favorable with that particular party, or he may not have sufficient financial resources to honor the contract. In all these cases, the party who has really gained out of this contract is suffering a loss because of the default of the payment by the other party. That is what is being perceived as one of the biggest risks, and the exchange, as a part of the futures contract, primarily wanted to address that particular risk, and that is where the margins came into picture. And the way the margins are going to work is whether a party is entering as a buyer or a seller into the futures market. With the exchange, both of them are supposed to maintain an account, and that particular account that both the buyer as well as the seller have to maintain, with the broker. Right here the hierarchy is like this. At the exchange level, there is something called clearing house, which will take care of the entire clearing and settlements and making sure that the counterparties are not defaulting. This is the wing of the exchange which takes care of the entire clearing and the settlement process. This particular clearing house has a few members called as a clearing house members. These are the ones that will transact with the clearing house, and clearing house members, for each clearing house member there could be one or more brokers who are transacting, and under each broker there could be one or more investors. This is the typical hierarchy. Now, the investors who want to get into a futures contract, they may have to maintain one account with the broker, and that account is called as a margin account. Similarly, brokers will maintain one account with the clearinghouse member, and clearinghouse members will maintain a margin account with the clearinghouse. This margin account which a clearinghouse member maintains with the clearinghouse is called as the clearing margin, or the typically the clearing account, wherein we call it as a clearing margin. Whereas here this margin which the investors are depositing with the brokers, initially for every trade, depending on the value of the trade, let's say if the buyer position is for 20,000 bucks and it is said that the initial margin is 10%, then both, when the investor, whether he is entering into a long position or a short position, whatever is the position, he has to deposit certain initial margin with the broker. So probably if I say 10% is the initial margin for a trade worth 20,000, both the long position as well as short position will be depositing 2,000 bucks. So that particular margin is what we are calling as the initial margin. So at the time of entry into the contract, whatever is the amount that is deposited by the investor with the broker is known as the initial margin. So in this case, let me assume that for a deal of 20,000 bucks, both have maintained a margin account with the broker, A being the long position as well as the short position. Now, this this account is settled on a daily basis. The amounts in this account are settled on a daily basis depending on the movement of the futures price. If the futures price has gone up during the day, long is going to gain, short is going to lose by the same amount. If the futures price has gone down during the day, the long is going to lose, the short is going to gain by the same amount. For example, at the end of the next day, let's say the value of this contract has become 19,500. So because the value has gone down, it is going to be a loss of 500 for the long. So the longs account is going to become 1500 and the shorts account is going to become 2500 because it's a gain of 500 to the short. This means on a daily basis the margin account is updated and settled at the end of each day. So for the next day, because the settlement is already done, it's as if that a new contract is entered into by both the parties with 19,500 as the contracted price. So this process wherein there is a daily settlement and the accounts being updated accordingly, we call this particular process as marking to market. We are marking the accounts of the various investors to the market price on a daily basis. So this is a real movement. It is not a notional account based representation. This is a real movement of funds from one of the parties accounts to the other, either from long to short or short to long, depending on whether the future price has actually gone up or gone down. So the broker of the investor who has gained will transfer the funds to the broker of the investor who has gained it. Right? That is one thing. And if at all the margin balance here, the margin balance is 2500, whereas the margin requirement, let's say, is only 2000. Initial margin requirement is only 2000. Then the 500 is called excess, and this 500 can very well be withdrawn by the party in case there is any excess. And at the same time, the exchange has to make sure, or the clearing house has to make sure that this number does not go negative. And to make sure that it does not go negative, it has brought in the concept of maintenance margin, which is generally some percentage of initial margin, probably let's say 75% of the initial margin. So in this case, the 75% of the initial margin 2000 is, let's say, 1500. Now what it indicates is, as long as the margin balance is more than that maintenance margin, nothing happens. The trades continue the same way. But the moment the margin balance comes below the maintenance margin, so assuming that this is below the maintenance margin, this particular party will receive a margin call to replenish the funds. And the objective of this particular party is take the account balance back to the initial margin level. Take the account balance back to the initial margin level. So right now it is 1500. So you add 500 to this margin account, take it back to 2000. Because the initial margin was around 2000. So this additional 500 that got added to take the margin account back to the initial margin is what we call as variation margin. That particular amount that needs to be deposited in case of a margin call to take the amount in the margin account back to the initial margin level. And in case any client fails to deposit that, the broker can very well close out the position by selling off that particular futures contract or getting into a long position on the by taking an offsetting position of that particular contract. The whole position will be closed out for that particular client. So that is what happens as a part of the margin account. And one more interesting aspect here is in the amount that has been deposited as a margin, there is a possibility that the investor can gain an interest on it. So if the interest rate is competitive, it even makes a lot of sense. It is not really boiling down to the cost. It is even coming out much better kind of an investment opportunity. And in some cases, instead of cash, we see that the treasury bills are being deposited as a margin. Generally, 90% of their face value is being taken. And similarly, in some cases, shares also can be deposited as margin. Only 50% of their market value is being considered for the same. And some of the good things that differentiate a futures from a forward are probably the mark to market, especially is it's a daily settlement. Rather than waiting for the end of the maturity period and suddenly realizing that the loss is too high for one party, or there is a possibility that one of the parties can default very badly, rather than realizing this at the end of the period, it can very well be evaluated at the in the initial stages itself, and the losses may not be anywhere significant. And that is what the margin and the daily settlement mark to market is working towards, to eliminate the credit risk in the process to a very large extent. So it's as good as if it is a 30-day contract, it looks as if we are getting into 31-day contracts, because each contract is settled at the end of the day and a fresh contract is being entered into at the new day. So it's like every contract is closed out at the end of the day and a new fresh contract is opening at a new price every next day. So the value of the contract to any party at the end of the day is going to be zero itself. That's one major advantage that can come with respect to the daily settlement process. So coming to how much should be this initial margin? Should it be 10%? How much should be the maintenance margin? The minimum levels for each one of them are typically set by the exchange itself. But the brokers, as a part of their typical setup, they can charge higher margins if required, based on the kind of relationship they have with their client. They can very well charge higher margins from their clients, but obviously they cannot charge the lower margins than what the exchange has typically specified. The more and more volatility that particular instrument is, if the stock is highly volatile, then probably the margin requirements for that are going to be much higher. And the other side of margins comes from the role of the trader. Generally, we see that the margin requirements for a hedger will be lesser than that of a speculator, because in case of hedger, the uh, the the trade that is being performed is in line with the exposure that they are typically going to have, and at the same time the chances of default are much lesser. So because the risk is much lesser with respect to a hedger, the chances of default also are much lesser, which means the margin requirements could be significantly lesser. Whereas they can quite comfortably be higher when I am looking at from a speculator's standpoint. Similarly, even compared to a hedger, I see a day trade or a spread trade will have much lesser, these two trades will have much lower margin requirement. Again, for the simple reason, the day trades are generally settled at the end of the day itself. So the broker is assured that the settlement is happening at the end of the day itself, so the risk involved is much lesser. Right, so because the trader is informing the broker that the position will be closed out before the close of the day. So there is the exposure whatever to the risk is only for one single day, which will not be that drastic. So the margin requirements are much lesser. Similarly, when we are talking about spread transactions, spread trade, it is more like a long position on an asset, on some asset, for one maturity month, for let's say one maturity duration, and a short position for another maturity duration. So it's like an arbitrage itself, but not immediate. So basically, it's like the long position. Let's say I have gone for wheat futures. If I'm executing a spread trade, it is like I go for 200 contracts long position on August futures, whereas I go for the same 200 contract short position on October futures. So this kind of a position which we are creating, where long and short both of them are being taken on the same asset, but with a different maturity dates. That kind of trades are typically called as spread trades. Even those spread trades will have a slightly lesser margin requirement compared to the hedging position or even the speculating position. And another important point that comes out in this context is whether you enter into a short position or a long position. Whatever is the position you are entering into, the margin requirements are the same, because the difficulty levels in entering into a short position or long position is more or less the same in case of the futures market, but when it comes to the spot market, that cannot be the same. What we typically see is, in spot market I can very comfortably end into a long position, the buying process, but I cannot get into a short position, the selling process, without owning any asset. So here the short position becomes very difficult in a spot market, whereas in case of futures market, it is quite comfortable to enter into a short position. And now discussing out the major role of a clearing house in the process. As we have discussed, it is the prime intermediary between the various parties, the buyer and the seller, because this is the one that is ensuring or guaranteeing that the other party is not going to default. So as I said earlier, the clearing house will contain clearing house members, and again these may have brokers, and brokers may have individual traders. So, brokers are channelizing their trades through a clearinghouse member, and clearinghouse member is again directly dealing with the clearinghouse, which is the exchange arm itself. So, all transactions that are happening during the day, the net positions, how many are open, how many are closed, all of them are being tracked by the clearinghouse at the end of the each day. And for each trader, the net positions are being tracked by the clearinghouse. So, when it comes to the process, investor or a trader maintains a margin account with the broker maintains a margining account with the clearinghouse member, and clearinghouse member is maintaining a margin account with the clearinghouse. So this is known as clearing margin. But in case of clearing margin, only the initial margin exists, which is otherwise called as original margin. There is no concept of maintenance margin in case of clearinghouse. Whereas in case of individual trader, there is an initial margin as well as the maintenance margin. So typically the amount that needs to be there in the margin account is nothing but whatever is the original margin multiplied by the number of contracts. So here what could happen is wherever there is a decrease, wherever it has fallen below the number, the clearinghouse member is supposed to deposit additional funds, otherwise a withdrawal of the funds can very well happen. And the number of contracts, sometimes it could be on a gross basis, which will include both the long positions plus the short positions, or it could be based on a net. The margin requirement could be on a net basis, which is primarily looking at offsetting between the long and the short positions, and only the net is being taken. So it's as good as probably long minus short or short minus long kind of stuff. So that is what is coming out as a part of the net number of contracts if they are considered for the determination of the margin requirements for the clearinghouse member. But at the end of the day, the main intention of doing all this margining and everything is try to eliminate the credit risk that is involved in the process, eliminate the chances of default of one of the parties in case the prices don't move favorable to that particular party, right? So even in the worst case, the party should be in a position to pay off the funds, and that is what is one of the major intentions of this entire margining system. And this entire concept of margining has even moved into the world of forward markets today by a term called collateralization, which is exactly on the same lines as the margin, but each party maintains a collateral with the other party because there is no centralized exchange in the process. Each party tries to maintain a collateral with the other party, and provided the value of the contract has gone down, the short will be the long will be paying to the short on a daily basis, and if it has gone up, the short would be paying to the long. So this kind of day-to-day settlement, kind of a virtual marking to market happens even on the forward contracts, so that the overall risk can be reduced to a drastic extent. Now, looking at what are the daily, I mean, if you look at on a live basis, or even the typical newspaper quote that is associated with a futures contract, we see the following elements in it. One, the opening price. the price at which the contract started uh, in this particular day, the high price during the day till date, right from the morning till now, the lowest price during the day. Then there is something called settlement price. Important point to note, this is the price that is generally used for settlement, gains and losses, to finally assess the overall gains and loss for the day, to overall move the funds from one account to the other account, and even the amount that is used for determining the margin for the next day. And we also see the percentage change in the settlement price from the previous day to the current day. Even that would be published on a day-to-day basis. And we also see something relating to the open interest. Open interest for each contract. So which is talking about the number of contracts outstanding. So which is like a number of long positions, which is equal to number of short positions which are not yet closed, which are still open. This is not the same as volume, because a position which has a long, if there is a long position and it has been offsetted with another short position, in case of volume it's like two positions, two contracts, whereas when I'm looking at the open interest, this is offsetted each other, so it's as good as a zero. So that's the reason in some cases we see that the volume is more than the open interest at the end of the day. So some kind of understanding of this is also very much required. And just by looking at these numbers, I should be able to assess some kind of patterns in the futures prices. Generally, if I see that the settlement price increases with the maturity, means the January futures price is less than the February futures price, is less than the March futures price, and so on, which means the settlement price or the futures price, it keeps increasing with the maturity period. Then such kind of markets are called as normal markets, because as time passes I see that the price also has to increase, so they are called normal markets. But in some cases what we see is the future price of January will be greater than the futures price of February, which will be greater than the futures price of March, which means as the settlement price is increasing, the futures price is actually falling. These kind of markets are typically called as inverted markets, and in some cases we also see mixed kind of markets, where for some period they are growing and in some other period they are falling. So understanding the pattern of the futures prices is very much necessary to make our appropriate moves with respect to the trading in these futures. All right. The next important aspect to discuss in this context is the delivery part. Though we have agreed upon the fact that majority of the futures contracts get closed out before the delivery, but if at all any of those future contracts lead up to delivery, what is the process? So the period during which the delivery can be made, the period during which the real delivery can be made, is actually indicated by the exchange. So whosoever especially the party who is going with a short position in the futures market. So those parties who have the short position, they can really decide on whether they want to deliver their particular asset or they want to close out their position. So whenever the short position wants to make the delivery of the asset, these parties through their broker, they issue they give a notice of intention to deliver to the exchange. So in that notice of intention to deliver, they clearly specify the number of contracts which they can deliver, and even the location of the delivery, and probably the quality grade of that commodity. All these things will be specified in that intention to delivery. And what is typically seen is the with respect to this intention, expressing the intention to deliver, we look at probably what is called as a first notice day, the first day on which this kind of intention can be intimated to the exchange or the clearing house. Similarly, I have a last notice day. This is the date before which the intention to deliver needs to be informed to the exchange. And there will be a last trading day, which would be a few days before the last notice day. And based on this is what the typical deliveries are being settled out. But yes, let's say a party who is willing to deliver, who has given the notice of intention to the exchange or the clearing house regarding the delivery, then the exchange will try to work out with a party with a long position, and chooses one party with a long position and delivers this notice of intention. Generally, the exchange chooses that particular party with the oldest outstanding long position. So, if any long position exists, and probably it's the first long position, but if it is closed out, if it is offsetted, then the next oldest long position is being considered. So whichever is the oldest outstanding long position, that would be identified by the exchange, and the notice of intention to deliver, which was initiated by the short position, is generally passed on to that particular long position. And that particular long position has to accept that notice, and if there is a transferability that is possible to that particular notice, it has to find a suitable party who can actually go for buying it within half an hour time frame. So the time frame that is available is pretty limited, so simply it has to go in terms of either closing out the positions or accepting the notice of intent for delivery. And generally, whenever we are talking about a long position taking a delivery, it's more like a warehouse receipt with an immediate payment. And in case of financial related futures, it could be a simple wire transfer, so no other expenses are involved in it. But with respect to the commodities, this kind of warehouse receipt is the one that typically happens. So right from the day of the notice of intention being received to the actual delivery happening, it will take typically 2 to 3 business days. So this is what happens as a part of the delivery in the futures contract. Now, in the futures contract, what are the key types of traders who are there? I can classify them primarily into commission based brokers who actually trade on behalf of their clients and who charge commission, and two, the locals. So these are the two major locals are the guys who trade for their own accounts. So these are the ones who trade for their clients and charge a commission. These are the ones who trade in their own account. Now these kind of traders, they have another classification depending on whether they are hedgers. As we have discussed earlier, there could be hedgers, there could be speculators, there could be arbitragers. But the world of speculators again is broadly classified into three groups. One are called as scalpers. Scalpers are those people who look out for very short term trends. Within few minutes they close their positions. Very short term positions, very short term trends, and try to profit from that small, very small changes. But they play in high volumes. Those are called as scalpers. Then we are looking at day traders who generally close out their positions within a day. They don't close out in minutes. Probably the maximum they try to hold on to their position is 1 day. So that's where they are called as day traders. And they don't take it to the next day. Whereas the position traders are another kind of speculators who generally hold on to their positions for longer periods, could be for months. They look out for huge changes, significant changes in the price, and they want to take an advantage on that heavy changes in the price. So from a trader's perspective, these are the classifications that I can typically look at. And now the different kinds of orders that could be placed in the futures market. One is a very common market order, which is like immediate placement of the order, immediate execution of the order, and whatever is the best price that is available in the market. That is called as a market order. Sometimes we set what is called as a limit order, wherein we specify the price and the order will be executed at that price, or a better price. So in case of a buy transaction, the order will be executed for a price, for that particular price or lesser than that. And in case of limit sell order, the order will be executed at the specified price or for a higher price. Similarly, I can look at stop order. So this is also specifying a price, but the intention in case of a stop order is closing out unfavorable position. So something is not going in our way, we are stopping the extent of loss. So they are also called as stop loss orders, stopping the extent of loss and closing out the positions at that point itself. Let's say I have already purchased the stock at 35. Now I have set a limit order, let's say at 40 to sell it. So if the price crosses 40, then the sell will be executed. But at the same time, I may have a stop order for 30. Means if the price goes even below 30 also, immediately execute the order. Sell off. Because I don't want my loss to accumulate. Because I have already bought it at 35. I want to get rid of it at 30 so that my loss does not pile up. So such kind of orders can very comfortably be executed in the market, or I could create some kind of a discretionary kind of an order wherein it's as simple as a market order, but some kind of a flexibility being given, some kind of a discretion being given to the broker to just delay it if he feels that something else might be more favorable for the client. And in general, all these orders are day orders. If they are executed, if nothing is mentioned, they are executed during the day, and in case they are not able to be executed like limit order, it's no guarantee that it will be executed during the day. If the price or a favorable price is not touched, it need not be executed also. So that is where the day orders, they can expire at the end of the day if they are not executed. But in some cases, I can see the time of the day kind of orders, means either the specific time during a day is mentioned, so the order can be executed at that particular time, otherwise it is expired. Or we talk about open orders, or otherwise called as good till cancelled GTC orders, means they don't have a day specification here. Until you manually close them or cancel them, or until they expire, they are open itself. They can be executed at any point in time. So these kind are, there is one called fill or kill kind of order. It is more like either it is executed immediately or it is killed. So these kind of orders can very well be existing in the futures market. Of course, more or less all these orders are there even in case of a regular stock market also. Similar kind of things are carried forward to the futures market as well. And finally, in this session, I am also going to look at the accounting related aspects, what numbers are taken in what situation as far as the derivatives transactions are concerned. So when I have to look at it from an accounting perspective on a broader scale, I first need to understand whether this particular futures transaction is more from a hedging perspective or from a speculation perspective. If it is known that this particular futures transaction is more from a speculation perspective, then whatever the gains or losses that are occurring as on the balance sheet or financial statements preparation date, the gains or losses are recognized directly in the income statement itself. So for example, I have got into a futures transaction. Let's say the long position on 100 contracts of 100 contracts of wheat. Let's say in February, in February 2014 for a May 2014 delivery. And probably on that day I have entered into the contract. The contract price was, let's say, 3,000 bucks. The futures contract was 3,000 bucks. And let's say on the balance sheet preparation date, which is the March 2014, this futures price has gone to 3,050 per contract, and probably 3,200 per contract on May 2014. Now, if this is purely from a speculation perspective. Whatever the from a long position, this is a gain. So the gain of 50 per contract multiplied by 100 contracts. So 5,000 as a gain is shown in the income statement of 2014, because the March 2014 is the end of the financial year, whereas this May 2014 goes into the financial year 2015. So whatever was the remaining gain from March to May, the 150 per contract multiplied by 100 contracts, so 15,000 gain is represented in the 2015 financial statement. But if the same is being used for hedging purpose, if it is known that the same contracts, 100 contracts are entered into from a hedging standpoint, the entire gain of 200 per contract multiplied by 100 contracts, 20,000 bucks, is realized as a gain, will be treated as a gain in 2015 only, whereas in 2014 that 5,000 will be treated as unrealized kind of a gain, and because of this unrealized gain, it goes into the balance sheet. It does not go into the income statement, it goes into the balance sheet as a part of other comprehensive income, which will talk about the unrealized gain on derivatives transactions. Unrealized gain on derivatives transactions. So this is the kind of an entry that comes up, and it is a part of the shareholders equity as well. And one of the major things that is coming up from an accounting perspective is all the transactions, all the derivatives based transactions need to be included in the balance sheet at the fair market value itself. And lots of disclosure requirements are associated with respect to the trading of the derivative securities. So all these things have to be very much disclosed by the firms, because earlier these kind of disclosure related stuff, these kind of unrealized gains and losses kind of stuff have created huge impacts on the positions of the various organizations, and they have resulted into huge losses for each of these organizations. So the accounting requirement became a bit more stringent as far as the any derivative transaction is concerned. So all these various aspects are giving us the detailed insight into the mechanics of the futures market. Having a good understanding of the all these various terminologies and processes associated with the futures transaction will enable the person to get quite acquainted with the market and perform the trades more comfortably. All right. If there are any further queries regarding the same, you can very well get back to me by giving me a call on the number that I have provided below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.